Hello and welcome to today's webinar, Equity 101 with Growth, presented by Growth. My name is Patty Montoya and I'll be your moderator today from the Early Growth team. I have a quick note before we get started. The webinar will last about an hour and that includes time at the end for questions. So feel free to type your questions into the control panel and we will answer them at the end of the presentation. The next thing to note is that this webinar will be recorded and sent out to all registrants with the slide deck within 48 hours. You can also find the recording and all of our recordings on our YouTube channel, Early Growth. Now, before I pass this off to our speaker today, I'd like to tell you a bit about Early Growth. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuation. Now, without further ado, I'd like to introduce our panelist, Bini Lee. Bini is a CFP and a senior member of the financial planning team at Growth. She has over a decade of financial planning experience. Bini started off her career building plans for her new parents to help them map out their future and prepare for catastrophic events. More recently, she worked at a traditional wealth management firm in Marin County, advising high net worth clients on how to not outlive their money and to strategically pass on their estate. As a senior financial planner at Growth, she manages a team of advisors as well as working with clients directly. Hi, Bini, and thank you for being here. It's all yours.
Thank you, Patty. Thank you for that warm welcome. And thank you everyone for being here. Welcome to today's webinar. I hope you will find it useful. A little bit about Grove. We are a company aiming to make honest, straightforward financial advice the new normal. So assisted by technology and great design, we get to know our clients and their goals and then create and deliver a clear strategy to help them achieve them. If you want to know more, I'll be talking a little bit more about our service at the end and have a discount code for you. A little bit of housekeeping items. There is a chat box available for your questions. And then, like Patty said, Q&A session at the end if we have time. So yeah, without further ado, let's get started. So many of you joining us today will hope to have your company IPO or have one coming up. Congratulations. That's an incredibly exciting place to be, and it can also be overwhelming. While everyone dreams of their startup having, some worth and some equity, it also comes with a number of decisions to make, all of which have implications on your financial life. From my experience of working with clients in these situations, I know that making these decisions can be confusing and stressful. The goal of today's presentation is to give you some clarity about what to think about, as well as to educate you on the various implications for various decisions. And as you think about how to manage your equity, and as a preview of some of the questions we'll dive into on the webinar, I thought a brief example of the work that we do might be helpful. So I recently worked with a client whose company was going through an IPO, and they really wanted to determine kind of when to sell, how to set aside money for taxes. Should they set aside some of the taxes of the money that they sell from their shares away for taxes? And then once they kind of get that money, what should they do with it? And what they really wanted to kind of figure out was, because they had a combinations of different types of equity compensation, a strategy for the different types of equity compensation, and then the timing of when to sell and when to exercise, in addition to once they net out and have this pile of money, what they can do with it. Can they purchase a larger home? Can they remodel their current home? All these other decisions that they wanted to do that was specific to their life and their goals. And I worked with them over several months to kind of figure out what the best game plan was for when this event were to happen. So yeah, if you have a recent IPO coming up, you have time to get organized, and you're already making a great step by being here to learn more and evaluate your options. On today's webinar, we'll discuss the different types of equity compensation you might have, how to plan for taxes, and how to determine the best strategy to exercise and sell your company stock. So let's get started with the foundation. What are the different types of equity you might have? This will inform what you should do with them. So the 4 most common types of employer equity compensation are: 1, incentive stock options. Patty, can you move to the next slide, please? Thank you. 2, non-qualified stock options. 3, restricted stock units. And 4, employee stock purchase plans. So let's start with ISOs and NSOs, since they're 2 different types of options, which basically means that you don't actually own the stock immediately. It's just an option that your employer is giving you to purchase the stock at a predetermined price. ISO is short for incentive stock option, and NSO is short for non-qualified stock option. The main difference here is that the ISOs can have a preferential tax treatment. Generally, early stage startups issue ISOs, and by the time they reach the growth stages, they issue NSOs. Once a company is an established late stage startup, they might start issuing RSUs, or restricted stock units. And companies tend to issue equity compensation in the form of RSUs after they have gone public. For this type of equity compensation, your employer will give you a defined amount of company stock, and it usually vests over 4 years. Once the stock is vested, it is available to you. A portion of this stock will automatically be withheld for taxes, and you can sell the rest as you wish. And finally, the 4th type of equity compensation, an employee stock purchase plan, or ESPP, is where your employer lets you buy the company stock at a discount. ESPPs are only offered at public companies. So if your company recently IPO'd or is about to, this benefit likely hasn't been available to you yet, but it could be a new benefit the company offers. So once you buy the stock at a discount, then you can sell it for the full price and capture the difference. If your company offers an ESPP, it can be a really excellent benefit because of the discount. All right, so for this webinar, we're going to focus on the first 3 types of equity compensation: the ISOs, NSOs, and RSUs. Let's start with the RSUs because they can generally be more straightforward than stock options. Like stock options, they have specific requirements such as a vesting period or a performance milestone that must be met before you technically own the stock or the restricted stock unit. And unlike options, however, there is no exercise needed. So you don't need to pay to receive the shares. Your employer simply grants you the shares, and once they vest, they're yours. In addition, RSUs carry no associated costs besides taxes, making them a really attractive part of your compensation. As your RSUs vest, a number of shares may be held back to pay the taxes, which makes it a little bit easier for you. You don't have to think about that part. And then, so moving on to the options, these remain the more popular form of equity compensation for private companies because they motivate employees to increase the share value by increasing the startup value. So let's dig in a little bit deeper. It starts with your company granting you an award package. So when you first got hired, your award package included your salary, your benefits, and the amount of the stock the company has given you the right to purchase. It also states the price at which you can buy the stock. This is known as the strike price or the exercise price. And the strike price does not change over time. And this is really what is special about joining an early age startup or early stage startup. The strike price will be set at whatever the fair market value of the stock is at the time, which in an early stage company can be pennies on the dollar. And one day, if it's $100 per share, if it's worth $100 per share, you have the option to buy it at the pennies that it was offered to you. If you hear about people talking about the 409A valuation, they're referring to a process your employer will engage in, typically with an outside provider, to determine what the fair market value of the stock is. So the 409A price is synonymous with the fair market value, or FMV. So we're talking about FMV or 409A valuation. Those are the same things. Every company shareholder hopes the value of the stock will go up. When the price goes up, the difference between the new increased FMV and the strike price that was determined for you when you got the grant is called the spread. So on the next slide, we'll go over a simple ideal scenario, just so we can understand the basics. In reality, there's a significant amount of uncertainty on what the future may hold. So this is a very simple example, just so you can understand the inner workings of an ISO. So the dark purple line is the strike price that was set when you got your grant. The fair market value at the time was $20 per share. And remember, no matter what happens to the future of the stock, you'll be able to buy it at $20 per share. When you decide you want to buy the stock, this is called exercising. So you exercise your option to purchase the share. And at that time, the stock, let's say, is worth $40, represented here by the light purple line. This means the difference between your strike price of $20 and the current fair market value of $40 is the spread. Once you have exercised the option or have purchased it, now you have to decide when you want to sell it so that you can turn around and make it into cash. Let's say at some point in the future, you're offered $80, either through a private transaction or after your company goes public, and you decide to sell. The difference between when you exercised the $40 price and when you sold the $80 price is what your gain is, which would be a great situation to be in. But things don't always go well for startups. So what happens if the fair market value goes down? The gain is now negative and your options are what we call underwater. The cash value of your options are under your strike price, meaning what you could sell the options for at this point is less than what you bought them for. This is a real risk. So I'll talk about when you should exercise your options here in a moment, but first let's talk about the taxes. There are two main types of tax treatment when you will need to keep in mind when exercising options. Income versus capital gains. Income tax applies to things like salaries and cash bonuses. Think about the percentage of each paycheck that doesn't hit your bank account because it's being withheld for taxes. The second type of taxes are called capital gains taxes, which applies to any profits that you make from selling an asset. So think if you bought a share of Apple for $100 and you sell it in the future for $175, then you will owe capital gains tax on the gain of the $75 difference and the $75 profit that you made. However, long-term capital gains rates can be much more favorable to you than income tax rates, depending on how long you hold an asset. Okay, so in addition to that, there are two times at which you may pay taxes on your options. This would be when you exercise your options and when you sell them. So how do these taxes affect my stock options? Remember when I said ISOs have preferential tax treatment? Well, let's go over how they might have preferential tax treatment. So let's start with the taxes that you owe when you exercise. The tax benefit of having incentive stock options is that their spread may not be subject to income tax. That sounds good to me. My spread is not subject to income tax assuming that you hold them for long enough to qualify for this favorable treatment. So when you decide to exercise or buy your options without selling them, you don't have income, so you may not have to pay income tax at that time. However, there's this pesky thing called AMT. So while you may not pay any income tax when you exercise your ISO, you might be subject to AMT, also known as alternative minimum tax. AMT is a separate tax calculation, and it can be pretty complicated. So what's important to know with AMT is that it must be paid in the year of exercise. So this is one of the things that you want to watch out for. You have to be really careful here, because if you exercise, that just means that you now own the stock. It's not money in your pocket. You just own it. You don't actually have money until you sell the stock. And if you sell it at a later date because, for example, you're waiting for the stock price to go up, or you're in a lockup window and can't sell, you'll still be liable and have to pay that AMT tax in that year. So you want to make sure that you have enough cash set aside to afford the tax bill. In fact, we've seen many clients in a situation where exercising their options would generate a tax bill higher than the balance of all their bank accounts combined. This is not a situation you want to be in. So to determine if you'll be subject to AMT, you'll want to talk to a tax advisor. Let's move on to non-qualified stock options. With NSOs, there is no preferential tax treatment when you exercise. The spread will be taxed as income. When you exercise, it will be included as wages, and withholding will be paid. So it's really just taxed the same as your salary and your bonus. To recap, if you have incentive stock options and you exercise them, you might not owe anything at the time, but you will want to confirm whether or not you'll be subject to AMT. And if you are, do you have the excess funds set aside to pay the tax bill? If you have NSOs, you will need to pay the income tax on the spread when you exercise. Now, that is exercising, but what about the taxes owed when you actually sell the stock? So moving on to the second possible taxable event. Okay, so this is where the holding periods are important. You now know the main tax benefit of having ISOs is startup employees do not have to pay tax on the day they exercise their equity, unless, of course, you owe AMT. However, in order to receive that benefit, you'll need to meet certain holding periods. The holding period requirement states that the day you sell the stock needs to be at least 2 years after the day your options were granted, and 1 year after the day your options were exercised. If you meet those two requirements, the entire gain above the strike price is taxed as long-term capital gains when you sell your ISOs, which, as I mentioned before, is generally a much lower tax rate than your normal ordinary income tax rate. However, you can't forget about AMT, because that also might be a possibility. If either of these tests are not met, then your options are treated as regular NSOs. This means that the spread portion at exercise will be taxed as income when sold. For NSOs, you'll pay income tax on the exercise, and then upon sale, you will pay capital gains tax on the appreciation from the value of when you exercised to the value of when you sold it. And holding it for longer than 1 year after exercising before you sell it will then result in preferential long-term capital gains tax rate. All right. So I think Patty here has the example of ISO versus NSO tax treatment to illustrate the difference. So again, we assume your strike price is $20 per share, and you exercise at $40 per share, and let's say, for example, you had 10,000 shares. Can you go back to the ISOs? Thank you. So to exercise them, it costs you $200,000, but you now have $400,000 worth of your company stock. So for ISOs, the difference between the exercise price and the strike price is treated as income when calculating how much you owe an AMT. How much is this really depend on your individual circumstances? It could be minimal, but is very likely, especially if you exercise a lot of options with a positive spread, you will owe taxes in the year of exercise. Then a year later, let's say the stock price goes to $80 per share and you decide to sell. Since these are ISOs and you have qualified for preferential tax treatment, you'll pay long-term capital gains on both the spread and the gain. This means, given our assumed scenario, there will be $222,000 taxes owed then. But why is the total tax owed $222,000? You'll likely be able to get the AMT tax you paid on the exercise over time through taking advantage of AMT tax credits, which can reduce your overall taxes owed in future tax years. So that's a great benefit. Now, if instead you have NSOs, you will owe income tax at exercise. So you'll pay $104,000 on the spread when you exercise. This is still assuming the same $20 strike price, $40 fair market value, and $80 sell price with 10,000 shares. Then, assuming again you've waited a year to sell your NSOs, you will pay long-term capital gains on the difference between the 40 and the 80, which is known as the gain. And this tax is equal to $148,000. So in total, in the NSO scenario, you will owe $104,000 at exercise plus the $148,000 at sale for a total of $252,000 in total tax. So in these identical scenarios, if they were ISOs, you'd have to pay $222,000, and if they were NSOs, you would have to pay $252,000. So that's how stock options work. Let's take a look at an example of if these were RSUs. With RSUs, your shares become taxable when they're released to you or when they're vested. So typically in private companies, RSUs are released to you when two conditions are met. Number one, the vesting requirement is reached and the company goes through a liquidity event, such as an IPO or an acquisition. And in public companies, RSUs are typically released after only the vesting requirement is met. In our case, let's say the company's share price is worth $40 per share when they release. Because you don't need cash to exercise your shares, you will owe income tax on the entire $40 per share, which comes out to be $208,000. Most companies withhold a portion of your shares to cover the tax that occurs with this transaction. However, depending on your overall tax situation, this level of withholding may not be sufficient, and you may need to set aside more funds today in support of this higher tax bill, particularly if you plan to hold on to the shares. Let's say you continue to hold on to the shares until stock price appreciates to $80 per share a year later and you decide to sell. The gain, or the difference between the $40 and the $80, is taxed at favorable long-term capital gains rates, or $148,000. Combining these two, this comes out to a total tax of $356,000. Now that we've covered the mechanics, let's take a look at some strategies to consider around what to do with your equity. The driver of your choice of what to do with your equity should be your personal circumstances, your goals, and what you plan on doing with the money. In order to determine the right time to exercise, we actually like to start with when you're going to sell. The primary strategies to consider are: 1, sell within the first week after your lockup ends. 2, hold until you have favorable tax treatment. Or 3, hold for the long term. Let's look at strategy number 1. If you plan to sell in the first week, the indicators that this might be right for you are: you have near-term goals that you want to achieve or to satisfy a tax liability. You need the money to fund the life that you want, meaning your cash flow right now is negative and you're spending more than you make. 3, you have a lower level of risk tolerance, meaning you personally can't take the ups and downs of the stock going up and down that will cause you stress and allow you to not sleep well at night. 4, not optimistic about the company. You still work at the company, but your feeling of the company's success is not as optimistic as some other people's views might be. And then lastly, you have the opportunity to get favorable tax treatment, but the time in which you'll be able to qualify for that is pretty far away. Those are the things that you might want to look at if you sell in the first week, if you want to consider selling in the first week. The reason you may want to follow the strategy is that you get to quickly reduce your risk and to have an opportunity to either use the money or diversify your investments. So let's look at why this is important. So let's say your company gave you $100,000 of cash today. Now let me ask you this. Would you turn around and buy $100,000 worth of your company's stock with that $100,000? For most people, the answer is no. You could use that cash to pay off student loans. You can use that cash to put towards a home down payment. You could use that cash to go on vacation or save for retirement, what have you. And if you were going to invest it, you'd probably buy more than the stock in just one company. You would buy a diversified portfolio. So this is how you should really think about your equity compensation. It's a way of your employer paying you, and now you get to take the next step of deciding what is best for you. Even if you don't hold a huge amount of stock in the company, you're still linked with its successes between any unvested equity and, of course, your future income and salary. One risk of this strategy is that the stock continues to go up and you have to sit next to your colleagues who might be enjoying the ride up. You may feel like you made a poor decision by selling, even if it was the right one for your circumstances. All right. So yeah, if you choose this strategy and hold the options, the second one is hold it until favorable tax treatment. If you choose the strategy and hold options, when should you exercise them? Should you exercise and sell in the same day? By doing this, you aren't exposed to additional risk that the stock drops between exercise and sale, and then you can use the sales proceeds to cover any exercise costs and tax owed. I think we're still on number 1. We haven't moved to, okay, great. Now we're on number 2. So strategy 2, hold until favorable tax treatment. Here are some indicators that this might be right for you. You don't need the money right away to fund any short-term goals. You don't need the money to fund the life that you want, or you're flexible enough if there is a large drop, so you're not spending more than you make. You're looking to maximize the potential value So you're kind of optimistic on the company, and you're a shorter distance away from the favorable tax treatment. So the reason to follow this strategy is to try and minimize the amount of taxes you pay. You may be able to lower your tax bill a meaningful amount in some circumstances if you have ISOs or if you have NSOs or RSUs that have appreciated a significant amount since the exercise or release. The risk to this strategy is that the stock could lose substantial value while you're holding it and waiting to reach a more favorable value. And second, that you owe taxes based on the higher exercise price. It's important to be mentally and financially prepared for these risks. I actually went over a client case yesterday where our client was holding on to company stock from a previous company that she was at, and she had enough for a down payment. However, when the most recent earning report came out, the stock dropped by 50% in a day. So while these can be really good things, they can change pretty quickly. So it's really important to be mentally and financially prepared for these risks. We highly recommend that taxes alone don't drive this decision. Even if your company is doing really well today and you have high prospects for its future, government regulations in your industry could change, and that could greatly impact the share price. The reality is that there are so many factors that could derail the stock price, even if things look bright today. So focus instead on what you are trying to achieve in your personal life with this money, and that will inform how you should treat it. So if you have enough cash to exercise or pay the taxes and are confident the company will IPO, then you should probably think about exercising now and utilizing this second strategy. All right. Now, the third strategy is to hold long term. What are the indicators that you might want to hold long term? Once again, you don't need the money right now for short-term goals. You don't need the money to fund your life, so your cash flow is good. And lastly, you're extremely optimistic on the company's prospects. The reason to choose this strategy is that your company's stock will increase more than any other potential investments. That's a pretty big statement. More than any other potential investments. The risk, however, is that the company underperforms other investments or loses value on an absolute basis. We highly recommend that clients diversify their holdings and don't hold more than 5 to 10% of their portfolio in a single stock, just to limit the risk. Imagine one day you have 95% of your net worth in your company stock and it drops by 50%, and then of course your net worth is now down 50% when you had the opportunity to sell and diversify and reduce that risk. It is a real risk. So yeah, this last strategy is a really risky strategy. So even if you decide to have some combination of strategy that includes this, we generally guide against concentration in one company stock. With that said, we have plenty of clients that really believe in the future growth of their company, and there could be a place for a smaller amount of exposure in their portfolio. So if you choose this strategy and hold on to the options, then when should you exercise? Here, you should exercise as soon as you can. If you don't have the cash, wait until after the IPO and the lockup. At that point, you'll be able to exercise and sell enough to cover both the exercise costs and the taxes due. The choice of this strategy really comes down to your personal situation, the risk you'll be able to take on, and your beliefs about the future of your company. Like with the client I spoke about in the beginning, we often see clients who don't fall perfectly into one of these three strategies. This is where we would recommend a blended strategy. Maybe you sell some immediately, but have a plan for holding a portion of your equity for a later date to achieve optimal tax treatment. But the important thing is that you have to put together a plan in advance so you know exactly what you're going to do and you don't allow your emotions to kind of get in the way. As you wait for your company to IPO and be out of the lockup period, it's a great time to think about what is most important to you. For example, maybe you want to purchase a home. Think about when you want to purchase that home, where you want to purchase it, how much it will cost, or maybe you want to pay off your student loans. How much will that cost? Or how much interest will you save by paying off your student loans? Or you might be charitably inclined. There is, some cause that you're really, really passionate about, and you want to be able to help further that cause. Or maybe this windfall will help fund long-term savings to get you on track to retire earlier than you might have had you not had this large windfall. What you want to do is prioritize these goals so you're clear on what is most important to you. And this is an incredibly personal decision. I've had clients that the thing that they want to do is retire the earliest day it is for them to feasibly retire, and that's their number one goal. Other clients really want to purchase a home, and they'll work longer if it means that they can purchase the home that they want. So, whoever you are, you really need to just kind of sit down and think about what is most important to you. Let's see. Yeah, and this is really why people hire financial planners. A financial planner will listen to what you want to achieve, assess where you are now, and work with you to build a strategy to get there. We can help with a decision of when to exercise and when to sell, help to balance near-term goals and long-term goals like paying for your children's education or your own retirement, how your equity compensation fits in. And we can calculate what you're on track for, or if you need to make adjustments to your savings or investments, and really help you take the emotion out of the situation so you can make the best decisions for you. A lot of my clients just use me as a sounding board and say, Bini, what do you think I should do given, you know what my goals are, you know what I want. Which path do you think would be best for me based on what you know? And I think that's definitely my favorite part of the job. And Grove can certainly help you with all of this. We'd love to talk to you, but there are lots of options for financial planners out there. So regardless of which financial planner you do choose, one question that you should be sure to ask them is if they are fiduciary, which means they are legally obligated to act in your best interests. And because everyone's tax situation is different, I'd highly recommend working with a tax advisor who can specifically prepare an analysis for you. What you want to know is, given various stock prices, how much tax will I owe? When do I have to hold the stock to get a lower tax treatment? However, the strategy that creates the smallest tax bill may not be the best strategy to accomplish your goals, which is why it is best to have both a financial planner and a tax advisor on your team. And I want you to keep in mind that if you have a big tax bill, it's because you made a lot of money on your equity. And that's a good thing. We want to balance paying taxes with you selling equity, taking money off the table and using it for other purposes. On top of that, there's a significant amount of uncertainty during this process, which is why having an option to buy is such an amazing, complicated, and potentially stressful perk. So let's see. To recap, figure out if you have ISOs, NSOs, or RSUs. You may even have all three, as my client did. And remember, they are all slightly different in how they work and what type of tax treatment they receive. 2, determine what is important to you. Prioritize these goals so you're clear on what is most important. This will inform the best exercise and strategy for you. 3, plan for taxes. Even though you may know the basics on what tax treatment each type of equity receives, you'll want to work with a tax advisor to see how that fits in with your overall tax situation. A great place to search for a local tax advisor is through coworkers and friends. Don't be afraid to ask around for a trusted referral. And lastly, create a strategy for when to exercise and sell. We went over the 3 strategies. A, sell within the first week after your lockup ends. B, hold until you have a favorable tax treatment. And C, hold long term. With most of the clients that we work with, the optimal strategy we develop with them is some type of blended strategy, and it's informed by the goals they are working to achieve, their values, and the resources they have available to them. If you'd like to talk through your situation, we can work with you to help you clarify your goals and determine the best steps to help you reach them. We'll work with you to build a fully customized plan so you can confidently make decisions that will make the most of your equity and help you achieve your goals. So now we'll move into the Q&A session. But first, as I thank you for joining the webinar today, I'd love to tell you that we're offering $100 off a Grove membership. To get the discount, go to hellogrove.com/events and click the button to get started. You can either make a deposit right away or schedule a time to speak with one of our certified financial planners one-on-one to determine if Grove is the right fit for you. So once again, to get the discount of $100, hellogrove.com/events. All right. Now let's open it up for the Q&A session.
Hi. At the moment, we don't have any questions. Please write your questions on the chat, and Bini will be able to answer any questions you might have.
Great. And if you don't have any questions now and you're thinking about this and you have questions later, you can also email us at contact@hellogrove.com.
Bini, we have one question. It says, as an advisor offered options to buy stock in the future, when does he come up with income tax?
Sorry, let me see if I can see the question. Is this, I'm the way I'm understanding this question is for options to buy the stock in the future, when is the tax event? So if you remember, there's 2 tax events, one when you exercise and then one when you sell. So for ISOs, when you exercise, there's no income tax, but there may be AMT tax. And then when you sell that, if the sell price is above the exercise price, which is the gain, then that's what you'll pay taxes on, the gain. And then for NSOs, when you exercise, you'll pay income tax at exercise in addition to paying when you sell on the gain.
Bini, we have another question. It says, how do startups choose between issuing ISO, NSO, and RSU? What are the determining factors?
It's funny because the ISOs have been a long time standing issue of, those have been the options of choice to issue as a very early stage company. And a lot of the preferential tax treatment goes away because a lot of the times clients don't want to hold on to the ISOs for the preferential tax treatment. They really just rather diversify. So I think when you're thinking about when to issue ISOs versus NSOs, the ISOs are really in the early stage company when you want to have the incentive for your employees to really grind and make the value of the company much higher than it currently is. And then the NSOs are when you're in more of a growth stage. And then of course the RSUs are typically when after the IPO, that's when RSUs are typically issued.
We have another question. So do NSO or RSU qualify for an 83B election?
The RSUs do not. The ISOs and the NSOs do.
Okay, Bini, I think those are all the questions for now.
Okay.
I will share with all the attendees the recording, the PDF of the deck, and the credit that Bini is giving you guys, as well as our contact email if you have any other questions for Grove at this moment. So wait for that email. It should come in the next 48 hours. Bini, thank you so much for your time and answering all these questions.
Thank you, and thank you everyone for joining us today. Have a good one.
Okay, bye.